you Welcome back to another episode of In the Money. I'm Roberta King, a Vice President and Branch Leader with Fidelity Investments, and with me today is Tony Zhang, Chief Strategist of OptionsPlay. Tony is a frequent CNBC guest. Tony, it's good to be back with you. Welcome today.
Thank you so much, Roberta. A lot has happened in the markets in the last couple of weeks, so really excited to break down what we're seeing and what our outlook is going forward.
I agree. Looking forward to it. So today is Thursday, January 23rd, and it's been a very busy political week. And of course, that's come with policy forecasting. And then economic news continues to give us updates, especially on inflation. And it's helpful to start with some high-level views before we get into the nuts and bolts of our trade conversations. So Tony, let's get started today with your macroeconomic view of the markets. And can you just share with us what you're observing recently?
Yeah, thank you so much, Roberta. And as you said, this has been a week full of political agendas, and with a shortened week with Martin Luther King Jr. Day, a full earnings calendar on deck, we really had a lot driving the markets this week. But I would say that we had a pretty significant turnaround in terms of just the general tone and optimism of the markets, especially with the Trump presidency. Last week we had a little bit of a lift to that change in tone with the cooler than expected inflation print that provided a little bit of a bounce here for the overall markets. But this week going into the Trump inauguration, we really saw markets trade on a bit more optimism of the fact that there's expectations of some form of deregulation across multiple industries, as well as tax policies that are going to be more favorable for quite a few different industries as well. So what's interesting, out of all of this is that we saw small caps. If you look at IWM, the ETF that tracks the Russell 2000 small cap ETF, that outperformed the S&P 500. And what that shows me is that, the broader market is playing a bit of catch up here. And that's generally a good sign after what we saw was a bit of weakness here over the last couple of weeks. There was some concerns that perhaps we're near a market top and we're about to turn back lower here. But the fact that we're seeing the rest of the market play a bit of catch up here is really a good signal for the potential resumption of a bullish trend. We have the 10-year yield moderating back below 4.6%, which is going to reduce some of the immediate headwinds that we were concerned about here from the last couple of weeks. We were concerned that 10-year yields were going to reach 5% here. Those concerns have eased a little bit here over the last week, and that's provided, again, a bit of a lifeline for equities. And then just the general concerns around tariffs have kind of softened a bit here this week as well. Trump did not go with day one with those tariffs that he was talking about for China, for Mexico, for Canada. Instead, he's really opting for a more softer tone and be seemingly open to more negotiations. And that's been another driver, I think, of reducing some of the sourness that investors have had going into the inauguration. Was that concerns around whether or not tariffs was going to cause further inflation, tax cuts are going to cause further inflation. Some of that stuff has eased a little bit, and we're seeing that in the S&P 500. We bounced off of a major support level last week, that $5,800 level. That was a major line in the sand that we wanted the bulls to hold in order to confirm at least a neutral market, and that's exactly what we got last week. And now this week we're pushing up on all-time highs around 6,100. If we can break above 6,100, that would signal a new bullish trend here for the overall equity market. So like I said, we still have a pretty big shift here in terms of tone over the last couple of weeks. We also had earnings season this week show up pretty strong. You had Netflix, United Airlines reporting extremely strong numbers, really showing just kind of the resiliency of the U.S. economy. And that's part of what's driving the markets higher to these all-time highs and potentially breaking out higher from here.
Thank you. Yes, a lot of information to digest this week. And even this morning, I was looking back at some general historic interest rates just out of my own curiosity. And it did seem like trends were normalizing, meaning we're moving back to around where the averages have been since the 70s. Do you see this lasting or impacting the markets for the long term?
That's a really good question. If you're looking at, these levels being kind of the long-term average, then you're looking at some pretty long-dated charts here, probably 30 plus years of interest rate data. From my perspective, there's been a lot of regimes and a lot of different market regimes that we've been in over the last 30 years. It's hard to say exactly what the current interest rate environment will provide in the current environment that we're in. But I will say, generally speaking, when we think about interest rates and the impact that it has, there's really two things that we look at. How much debt is there, that was financed potentially at a lower rate, right? And that affects both governments, personal credit, as well as corporate credit. And we have seen a lot of debt issued over the past, call it 10 plus years, issued at much lower rates. And this is going to have a compounding effect for personal spending, companies that have to refinance their debt at a higher rate, and even the US government. Now, the second largest budget in the US budget is actually just servicing our own debt. So that certainly has a long-term effect and provides a bit of a headwind for equities at the moment. But the other thing that you have to look at is really just the expectation of where interest rates will be in the future. At the moment, we don't expect much in terms of rate cuts. Right now the bond markets are pricing only another 25 basis points of cuts in 2025. So the outlook here for interest rates is not particularly favorable for equities at the moment. But we have seen that shift quite a bit here over the past few months. We could still continue to see, if inflation continues to come in cooler than expected, we're going to see perhaps more rate cuts. And that's really what's the primary driver of equities. If we expect more rate cuts, that's going to be a tailwind for equities. If, let's say, we end up not cutting rates at all for this year and rates stay high, that's going to be a headwind for equities. So that's really kind of the two things that I'm primarily looking at.
Thank you for your perspective, Tony. So let's shift gears and get a little more tactical. And I understand that you have two trade ideas for us today. Let's get started. What's that first trade that you're looking to execute to find opportunity in the market this week?
Yeah, the first trade I want to take a look at is Nvidia, which I consider one of the most undervalued names in the entire S&P 500. And this week we saw a pretty significant announcement from President Trump, which is the Stargate project. Now, there's certainly some back and forth as far as how much money Stargate project actually has versus the headline number. But regardless, what's very clear is that the U.S. is trying to invest strategically in certain industries like they have been in the past to ensure that they are at the forefront of specific industries. And obviously, AI is one of the industries right now that everyone globally is focused on, and the US is trying to invest and make sure that they stay at that forefront. So Nvidia is by far going to be the primary beneficiary of such a strategic investment from an infrastructure perspective. When we're trying to advance AI for national security, for healthcare, for economic competitiveness, this is really where Nvidia is the brick and mortar that is required to build all of that on top of. So if you look at a chart here for Nvidia, we see that the stock actually over the past few months, after having a banner year for the last couple of years, have really gone absolutely nowhere. It's been trading between 130 and 150 for the better part of a year. However, this is generally speaking, this type of consolidation, this trading sideways, is healthy after a stock makes such a big move over such a long period of time. So what you have here is a bit of consolidation, and what I think is that we're primed for a potential breakout here. And the catalyst here is we have earnings in about a month or so for Nvidia, and now if we're really going to see some substantial amount of investment from the U.S. government and into these types of into AI as a venture, that's really what could potentially propel this significantly higher here. And if you look at how far the stock rallied into that 130 to 150 trading range, that would target easily 180 here to the upside. So there's a pretty substantial upside from where we are trading right now. But more importantly, I think that what most investors may not realize is just how cheap of a valuation Nvidia is actually trading at. It's only trading at 31 times forward earnings, which on paper sounds relatively high compared to the overall market trading at around 21, 22 times forward earnings. But when you actually look at the growth expectations and profitability of Nvidia, there's nothing that even touches a candle to that in terms of their growth rates. We're talking about EPS growth rates that are in the 65% range. Compare that to something like Apple, which trades at roughly the same valuation. Expectations for EPS growth rates on Apple is around 12, 13%, 65 versus 13. If you look at revenue growth rates, we're talking about 57% revenue growth rate for Nvidia versus 8 or 9% for Apple. And then if you look at net margins, meaning how much money do they make for every $1 in revenue, they're generating 55 cents in profits for every $1 in revenue. Compare that to Apple, which is only earning about a quarter for every $1 in revenue. So when the two companies trading at very similar valuations, one is clearly outperforming the other from a business perspective. That's really where I think Apple is severely overvalued and Nvidia is severely undervalued. And I think it presents an extremely attractive opportunity for traders and for investors, especially now that we have the news that we're going to see some investments from the US government into this particular sector. So the trade structure that I want to use is one that is a little bit more complicated, but I'll walk everyone through here. What I'm going out to is the March expiration. That's a little over 2 months from now. And I'm looking at buying the 145, 175 call spread. And what that means is that I'm buying the 145 call option. That's the at the money call option. And I'm paying about $12.05 for that at the money call. But what I want to do is I want to reduce the overall cost of this trade and reduce the overall risk of this trade by selling that 175 call. My upside target here is around 180. So I'm comfortable selling that 175 call, effectively giving away any further upside above 175 in exchange for about $3.05. And what that means is that instead of laying out about $1,200 just to buy that 145 call, I'm now only laying about $900 per contract to buy the spread. And that's going to reduce my overall risk. It's going to reduce my overall capital outlay, and it's going to also increase my potential returns if I am correct on this directional move. So net here, I'm paying about $9 for the debit spread, which just means that I'm risking $900 per contract. And because this is a $30 wide debit spread, the difference between those two strike prices, my total potential reward on this is $2,100 per contract. So I get more than a 2-to-1 risk to reward ratio on this type of trade if Nvidia is above 175 by that March expiration. And like I said, with the project, with earnings coming up, those are two potential catalysts that can drive the stock significantly higher. And that's what I'm that's what I'm trying to set up for with this specific trade. And it gives me a 2-to-1 risk reward ratio if I'm correct. And if it's below 145 at expiration, I'm risking $900 per contract, which is in this particular case about 6% of the stock's value.
Thank you, Tony, for sharing this trade. I do have a couple of questions regarding it. To start, you mentioned the trade is particularly poised to capture any price movement for Nvidia until March expirations. And based on your fundamental research and thesis, it sounds like there might be opportunity beyond March. And so if that's true, what are some ways investors can capture or structure trades or use tools to extend beyond March potentially?
Yeah, absolutely. So if there's really two scenarios that can play out, right? Either we get to March and we have not reached our 175, 180 price target, or prior to March, we end up reaching that 175, 180 price target if we are correct in our thesis. In both of those scenarios, what you generally want to do is you want to close out the trade structure that I just suggested here. And at that point, basically create a new debit spread. You basically want to recenter the debit spread based on the current price of the stock. So for example, let's say by March, the stock is up at 165 and you think that there's still further upside beyond March, then what you want to do is you want to, at that March expiration, look at perhaps buying a 165, maybe 185 call spread at that time. But depending on where the stock is at that time, you want to recenter the debit spread based on what the current prices are and basically buy further upside exposure using a trade structure like this. And using a debit spread, what you're really doing is you're trying to reduce the overall risk as much as possible. As you can see, instead of laying out $1,200 or risking $1,200 by just buying the call option, I'm only risking $900 by buying the spread. So there's two things that will happen. Either you're outright reducing less risk, I'm taking on less risk by using a spread versus a call, or what you can do is you can take on more leverage, meaning you can afford more contracts by buying the spread than you would if you were just buying a call option. So those are the two choices that you have as a trader when you reduce your risk, whether you just want to take the risk reduction or you want to take that risk reduction and maybe apply that to more leverage.
Thank you, Tony. So I want to ask the inverse of that. So conversely, your investment thesis could not pan out. And I'm always very interested in the practicality of trade management. So could you share with us some ways you would consider managing the trade if the thesis didn't come to fruition?
Absolutely. And I'm always glad that you asked this question because I always think this is the more important question for investors. There's a lot of things that you can do when things go right, but when things go wrong, there's really one thing that you can do. And it's really important that you do that one thing, which is making sure that you cut your losses if the trade doesn't go in the direction that you expect it to. So whenever you use a structure like this, whether it's a debit spread like the one that I'm showing you here, or if you just bought a long call option, the rules are the same. At least for me, what we find is that if you've lost 50% of the premium that you have paid for either a long call or a debit spread like this, chances are at that point, the thesis that you have is not working out, certainly not in the time frame that you're expecting it to work out in this particular case, the March timeframe. So if I'm paying $9 for this debit spread, and let's say fast forward a month later, the stock hasn't moved much, maybe it's moved a little bit lower, and now this $9 debit spread is now only worth half as much, $4.50. If that were to happen, my rule of thumb here is to simply cut my losses and move on. What that means is that instead of holding on to the trade and hoping that the trade will come back in my favor, what I'm doing is I'm basically closing out the trade, saving the rest of the $4.50 that I have left on that and applying it to the next trade rather than just holding it and potentially losing the other $4.50 on the trade.
Very helpful. Have an exit strategy is what I'm hearing. So Tony, let's move on to your second trade of the day. Can you share with us what else you're considering looking at when looking at opportunity in the market this week?
Yeah, absolutely. So we are certainly in the thick of earnings season, and one of the names that I really like coming up next week is Visa, and it's positioned to capitalize on a bunch of the long-term trends that we have continued to see over the last 10 years, which is, the move away from cash to more digital payments. I don't know about you, but I don't remember the last time that I paid for anything in cash, and just the general growth in terms of e-commerce. We buy fewer and fewer things in brick and mortar stores. We buy almost all of our items online, and Visa is the potential beneficiary of all of this, and supported by its industry-leading profitability, which is something that I think a lot of investors may not recognize just how profitable Visa is in this entire venture. If you look at the chart here for Visa, we recently just broke out above a major resistance. I'm sorry, we've been trading in a range between 300 and 320. We just broke out above that trading range here over the last few days. And what's interesting is that as it broke out above that, it outperformed the S&P 500, which is a really good sign going into an earnings announcement when you see that type of breakout while outperforming the S&P 500. That's a good sign for me going into earnings, which they report on January 30th. And then if you look at the business, this is similar in my opinion to kind of looking at it from the Nvidia perspective. This is trading at 29 times forward earnings, which again on paper sounds expensive compared to the industry median, which is around 18, and the market, which is around 22. But I think one of the things that most investors don't recognize is how profitable Visa is. Visa, for every $1 in revenue, generates 55 cents in profits. That's on the same par as Nvidia. Growth rates are very similar to what we're seeing in terms of the rest of the market. Like Apple, we were seeing EPS growth around 12%, revenue growth around 10%. That's in line with the rest of the market, but the profitability there far exceeds the rest of the market. The S&P average net margins on the S&P is around 12%. Visa is at 55%. And that's really what justifies the premium valuation that it trades at. So from my perspective, I think what I want to do is take a bullish view going into earnings next week by using a simple trade structure. I'm going out to the February expiration, which is roughly 1 month from now, and I'm buying the 320 call option for $11.95. And I'm specifically buying a call option that's already $6 in the money. So the Visa is currently trading at 326. I'm buying the 320 call option. And I'm doing so because I want to reduce the overall time decay that I'm paying for this type of for buying a call option going into earnings, because options tend to be very expensive going into earnings, and that all comes down to the extrinsic value of an option. So by buying an in-the-money call option, I'm reducing the extrinsic value part of the equation, meaning that's the part that will decay to zero at expiration if all things else are held constant, and I'm trying to reduce that as much as possible. So here I'm risking $1,100.95 per contract in exchange for unlimited upside going into earnings with limited risk. And this allows me to basically take effectively what is a short-term bullish view going into earnings with limited risk, but getting that leverage here to the upside if I am correct on my thesis for Visa.
Thank you for sharing this trade, Tony. And I'm really curious, as a follow-up question for this trade, as if an investor is looking at this trade, I'd like to talk a little bit about intent. For example, using the strategy could be for the purpose of exercising, meaning ultimately holding the underlying stock, versus trading for the potential increase in value of the contract itself, or potentially something else. Can you talk to us more about intent in long calls?
Sure, absolutely. So, the reason I'm using a long call going into an earnings announcement is because I want the downside risk limitation going into a volatile catalyst event like earnings. Because, there's always the chance that Visa, for whatever reason, misses on earnings. And we have seen some misses this quarter move substantially lower. So I want that downside protection. And that's why I'm using a call option going into an earnings announcement rather than outright buying the stock. Now, I do think, I like this stock for the long term, right? So I very well might, after the earnings season, if my thesis is correct, turn the long call into a stock position, right? I can exercise my call option and take the stock, or I can choose to use other types of trade structures. But it really kind of depends on whether you are thinking about this from a short-term play going into earnings, or you're thinking about this as a long-term investment. For me, at least for this particular trade, it's more of a short-term trade for earnings. That's why I'm using the call option trade structure. But if, let's say, I was a long-term investor, I might be more inclined to look at buying that stock, because that would avoid kind of paying any type of time premium that I do have to pay for with the call option.
That's helpful context. Thank you, Tony. So we do save time in each of our conversations to look back at past trade ideas and see how those played out. I find that these moments are really valuable lessons for all traders and investors. So today, I do understand that you're looking back at your December trade with Boeing. Can you tell us about that?
Yeah, that's correct. In December, I laid out a bullish thesis for Boeing. Effectively, I feel that Boeing is at the pivotal point of potentially a turnaround, a multi-year turnaround, what has been a bit of a sad story for the company, a sad decline. But I think we're currently turning a corner here with a new CEO, moving to Seattle, being a very hands-on CEO, kind of starting to focus on safety, focusing on increasing deliveries. What we did is we sold the January 175 put. At the time, we sold it for about $6.70. Now, at the January 17th expiration, which was last Friday, Boeing was just under 175. And what that means is that this put was assigned to the short seller of this put option. And that means for every contract you sold, you now own 100 shares of Boeing. But because we collected $6.70 on this credit, on the short put, your net cost basis of owning that stock is around $168.30. So you're already profitable on the stock investment here at this point. So I think what the best thing to do here, if you own the stock, meaning if you sold this put option and now you own the stock, what you might want to do is you want to look at start selling cover calls, because we effectively achieved our objective. Selling the put option was to try to acquire the shares at a discount. We were able to do that. Now that we own the shares, the goal here is that, with any share purchase is you hope that it's going to appreciate in value. However, at the same time, what you can do is earn some income while you wait for that appreciation. And that's exactly what I want to do here with a cover call. And if the combination of these two strategies, selling the put option to acquire the stock at a discount, and then selling cover calls once you do acquire that stock, is what we call the wheel strategy. So what I want to do is I want to go out to the February 28th weekly expiration, not the monthly expiration, the weekly expiration. I'm looking at selling the $200 call option against the 100 shares of stock that I own. And by selling that call option against the 100 shares, I'm basically pledging the 100 shares as collateral for selling that call option. Because if you were to just outright sell a call option, you would have to post margin in order to do so. But because you own the stock, you don't need to post any additional margin. And that basically brings in this particular case, a little over $1. Earlier today, you were bringing in about $1.01 for that $200 call option. And that's going to generate, a little bit north of 6% yield of your of the stock that you own on an annualized basis, waiting for it to appreciate in value. And if Boeing is below $200 at February 28th, you basically keep the $1 in premium, and you can sell a new cover call and keep generating income month after month until the stock reaches your strike price, at which point what you're doing is you're going to sell your stock at that particular strike price, and basically in my case would turn a profit if I were to able to sell it at $200. So the goal here is to basically try to sell your stock at buy your stock at a discount through a cash secured put, and then as you wait for it to appreciate in value, continuously generate an income stream through that cover call, so that by the time you sell your stock, hopefully you've earned not only the capital appreciation on the stock, but also a significant income stream alongside with that through the short put and the cover call.
Tony, thanks for sharing that. In essence, your look back has created a new trade. And if possible, I think it's helpful for all of our viewers to see these look backs. And if we could keep this one on the table, if we could potentially look back at that in a future date to see what other tactical strategies you might employ with this new trade, or tips for continued portfolio management that you could deploy with other option strategies with this long position.
That sounds great. We would love to do that.
Excellent. So we get to have a little bit more fun today. As part of this week's Options for the New Year event, we have the opportunity to take a few questions from our viewers. So Tony, if you're ready to have some fun in a speed round, I'm ready to ask some questions if you're up for it.
I'm always up for it, and please, let's this is probably the most fun part for me.
Yeah, same. So the first question I have is from Tom, and he's asking, are covered calls a good way to start with options trading?
Well, Tom, that's a great question, because a lot of traders are, I would say, attracted to options initially through, looking at things like buying a call option, because, who doesn't want the upside leverage with limited risk here to the downside? But I actually advocate for a lot of people who are starting out with options to start with cover calls. It is the only strategy within the entire options trading arsenal that you have at your disposal that doesn't add additional risk to your portfolio. And it's a great way to start just getting your hands dirty and getting a feel for how option pricing works as the stock fluctuates in value. Because that's really one of the most important lessons to learn before you start taking on additional risk in your portfolio. So if you sell a cover call, what you're able to do is see how the value of that call option changes with time and with the stock moving higher and lower. And this way you're doing so in a way where you're not adding additional risk to your portfolio, you're generating a little bit of income in your portfolio at the same time, and it's a really good way to start venturing your way into options. And once you feel that you got a bit of a sense for how option pricing changes with the time, with time passing and with the changing of the markets, that's really where you can start thinking about flipping it instead of selling call options, looking at buying call options. But once you get to that point where you're buying call options, you want to graduate fairly quickly to things like the debit spread structure that I use with Nvidia, because those are going to give you some of the best of both worlds. You're going to get the ability to capture some premium and collect some income, but also be able to speculate on the directional move of a particular stock like I am doing with Nvidia.
Thank you, Tony. I have another question here from Daniel, and he's looking at there's so many, I guess, choices to make when you're looking to place a trade. You've got various expiration dates, you have different strike prices. Daniel's really trying to ask, what strategies do you employ to select which option expiration date and strike prices to choose?
Daniel, this is probably the question that confounds most traders, even experienced traders. There's just so many options. There's over 6,000 symbols that you can trade options on. There are over 1.3, 1.4 million option series to choose from within that. There's just an overwhelming number of choices. So as far as like how do you go about selecting the appropriate expiration date and strike price, that's really predominantly based on back testing. We've done a huge amount of back testing, and it depends on each individual strategy. We do back tests for each individual strategy, and it's about educating yourself on these individual strategies that you are trading and what are the best practices for each of these types of strategies. Fidelity hosts weekly events on each of these strategies through webinars, and I encourage you to attend those webinars and understand more about what different expiration dates will do for each specific strategy so you can suit them for yourself. But generally speaking, most strategies have best practices in terms of which expiration dates you generally want to choose around, what strike prices you generally want to choose around for each individual strategy. You just have to learn them and memorize them to some degree for each of the strategies that you are trading in your portfolio.
Thank you, Tony. I have a question here regarding Nvidia, and it is probably prompted from your previous trade idea. And the question is asking, can you explain how to use an options collar as a strategy for Nvidia?
Sure. So an options collar is a strategy for if you already own the stock and you are to some degree perhaps concerned about some future downside in the stock, but for whatever reason, you don't want to sell that stock, right? It could be for tax reasons. It could be for other reasons where you're concerned that the value of that stock may decline in the short run, but you want to protect yourself against that. That's really what a collar does. And specifically, a collar is what a collar is trying to do is try to provide some downside protection for relatively low cost or even zero cost. Anyone can buy a put option on a stock that you own and get that downside protection, but the problem is buying a put option is very expensive. It's not something you want to do very often. It's something you want to do very, very sparingly, only when you're very confident that the stock that you're holding may decrease in value in the short run. So a collar, what it's trying to do is trying to offset some of that cost of that put option that you're purchasing by selling a cover call at the same time. So just like the trade that I'm doing in Boeing, where I've sold that February 28th $200 call option, what I can do is I can take the $1 in premium that I'm collecting on that cover call, and I go out there and I try to buy a put option. Chances are a put option is going to cost more than $1. Maybe it costs $3. But what I'm doing is I'm offsetting some of that cost of that put option. And the other thing you can do is if you truly are very bearish on a specific stock that you're holding, instead of selling a cover call like I'm doing that's $25 out of the money, you could sell a cover call that's much closer to the current price of the stock, bring in more premium, bring in more income, and that's going to offset more of the cost of that put option. So that's generally speaking the thought process that you have when you're thinking about using a collar strategy on a stock that you own.
Thank you so much, Tony. I'm going to go to a question from William, and this is a little apropos. So the title of our show is called In the Money, and his question is about what's the benefit of selecting a out of the money, at the money, or in the money? How do you choose which one you're choosing?
Fantastic question, William. So the thing about options trading and the thing about trading in general is that you have to recognize that all choices that you're making when you're making, especially when it comes to options, is you're basically trading off between two things. You have probability of success and risk to reward ratio. And these two factors are effectively, you can think of them as on a seesaw. If you have something with a high probability of success, it's going to have a low risk to reward ratio. Vice versa, if something with a high risk to reward ratio is going to have a low probability of success. So when we talk about in the money, at the money, out of the money, we're really talking about which side of the spectrum are you looking at. So when we talk about something that's in the money, that's something that has a higher probability of success, but it's going to have a lower risk to reward ratio. It's going to be associated with more risk than potential reward if you want something with high probability of success. On the flip side, if you're talking about something that's out of the money, then we're talking about something that is high risk to reward, meaning your potential reward is much higher than what you're risking, but you're going to have a much lower probability of success. Now, one is not better than the other. It's a matter of it's a spectrum, and where do you want to be in the spectrum? And at the money call option is sort of in the middle, right? So I would say that most people, or at least I suggest that for most people who are starting out, is to be on the more conservative end of the spectrum, meaning be slightly in the money, which like the trade sharks that I'm using with Visa, by be slightly in the money, meaning don't shoot for those really high risk reward trades where you're almost thinking, it's not quite a lottery ticket type payoff, but it's similar. You're risking very little to try to make a lot, but your chances of success are very, very low. You don't want to trade something where your chances of success is very, very low when you're first starting out. Those are really safe for when you're trying to hit the lights out and you're trying to hit a home run on something that you're super confident in. Then you might want to use kind of sort of that lottery type risk reward ratio. But for the most part, your everyday trade, you want to be on the more conservative end of the spectrum. So slightly in the money is usually where I like to start.
Thank you for that advice. I want to go to Amanda's question, and she's asking, can you please go over implied versus historical volatility and how you would incorporate that into an option strategy?
Great question, Amanda. This is starting to get into the deeper end of the pool, right? So historical volatility is referring to what has been the volatility of the stock in the past. Implied volatility is saying, what does the option market currently think the future volatility will be? And what you do is, generally speaking, you compare these two metrics to each other. If, let's say, implied volatility is significantly higher than historical volatility or vice versa, generally traders will see that as a trading opportunity, because volatility as a metric is what we call mean reverting, meaning volatility tends to trade around a long-term average. So if you have the option premiums right now, or if, let's say, the option market is implying that the future volatility is much higher than what the history has been, then you have an opportunity where you can effectively be short volatility. And this is, again, starting to get into the deeper end of the pool. But when you trade options, there is a Greek called the vega, meaning how much exposure does the option you're trading have exposure to changes in implied volatility. The idea is that if the implied volatility is much, much higher than the historical volatility, the expectation is that in the future, that implied volatility will come down. Vice versa, if implied volatility is much lower than historical, the expectation is that implied volatility will rise sometime in the future. So you can trade specific option structures where you have a relatively high exposure to that change in implied volatility. And what you're doing is you're basically trading volatility. Like I said, this is the deeper end of the pool, but that answers your question as far as what is the relationship between implied versus historical, and how can that be applied to your options trading.
Thank you, Tony. So I do have a question from John, who appears to be a regular viewer, and he's referencing that prior conversations from you, Tony, he's seen you reference both a 30% delta and a 40% delta for selling puts. And he's wondering, has your thinking shifted on which one to use over time, and if so, why?
So it's not a matter of my thinking has shifted on this. It's a great question, John, because when we think about selecting strike prices, and we had a prior question about how do you think about selecting expiration dates and strike prices, but whenever we select strike prices, we like to use delta. We like to use a delta-based approach in selecting strike prices because what delta gives us is the probability of the stock being above or below that specific strike price at expiration. So if you have when we're selling a put option and we talk about a 30 delta put option, we're talking about a put option that has a 30% chance at expiration, you're going to end up owning that stock. A 40 delta means there's a 40% chance. So as far as which one I tend to choose, it really depends on the stock that I'm trading. And also it depends on, how much I want to chase that particular stock, right? So, think about stocks that you really want to own, right? Those are the stocks that you might maybe even just place a market order and just buy at whatever the current price is because you want to get in, right? And that's really where you want to choose a higher delta, a 40, maybe even 45% delta for a short put. On your average stock where you're saying, I'm comfortable collecting in the income, I'm not trying to chase this stock, I want to be conservative, I want to be patient, then you want to choose maybe a 30 delta. So it's a matter of, how badly do you want to own the stock? And that's going to help you select the right delta.
That was a good observation from John. Thanks for answering that question. So I've got one here from Patrick, and he's asking, are there any specific indicators when you're looking at options to help when knowing when to close a position? So again, strategy and thinking through, how do you manage a trade?
Yeah, great question. So, when it comes to once you are in an options trade, first of all, I encourage everyone before you enter an options trade, you should be thinking about at what point do I want to close this trade before you get into the trade. This is not something you want to try to figure out on the fly after you've entered the trade. And there's really obviously two potential scenarios, right? The trade goes in your favor or it doesn't go in your favor. And it's really, in my opinion, far more important to plan for if it doesn't go in your favor and make sure that you have a plan for that. And generally speaking, the rules for if the trade doesn't go in your favor are black and white. There's generally no wiggle room as far as what to do if a trade's not going in your favor. And there should be a very clear threshold as to when you cut your losses and move on to the next trade. That's generally going to be based on the price of the option, right? Depending on whether you're buying or selling, there's slightly different rules, but it's always rooted in the price of the option and where that price is in the future as to when you want to cut your losses. Occasionally, those rules can be based on the underlying stock, meaning if you bought a stock because you thought it was going to break out from resistance and it doesn't break out from resistance, that could be an indication to get out, even if the option hasn't necessarily reached your stop loss level. And on the flip side, if the trade goes in your favor, that's really where it's more of an art than a science, because when a trade goes in your favor, you have a lot of options. You have a lot of different things that you can do. You can take profits and buy a new option and continue your exposure in that particular stock. You can just outright take profits. You can take partial profits. You can scale even more into the trade. There's a lot of choices that you have when the trade goes in your favor, but it's really, in my opinion, far more important for investors to have a clear plan for when the trade doesn't go in your favor, because that's really what causes a lot of traders to kind of potentially end up losing more money than they intend to, is not having that exit plan for when the trade doesn't go in their favor.
Thank you, Tony. It's really interesting because the next question I was looking at is from James, and I think it rolls, ironically, right into the question that Patrick had, and he's asking about at what point do you consider rolling a contract? Can you expand a little bit more on that once you've decided this is the strategy that you want to pursue?
Absolutely. So in the previous question, we talked about, how do you think about closing a position? And I said there's two scenarios, right? One where it goes in your favor and one where it doesn't. So when do you want to roll a contract is really only for when a trade goes in your favor. You generally don't want to roll contracts on a trade that's not going in your favor, because if a trade's not going in your favor, any type of roll is just simply trying to what you're effectively trying to do is saying, I've lost money on this trade. I'm hoping that I can make that money back by throwing more money at it, right? So uh, you're kind of throwing good money after bad money when you're rolling a losing trade. So I generally don't recommend ever rolling a losing trade. There are some scenarios where you can potentially roll half of a trade to try to repair a bit of a losing trade. And when you're trading more complex strategies like a butterfly or iron condor, but that might be, outside of the scope of what we're talking about here today. But for the most part, if you're just buying single leg options, if you're selling single leg options, if you're trading, debit or credit spreads, if a trade's going in your favor, you shouldn't be thinking about rolling. But if a trade goes in your favor, that's really where you want to consider rolling your contract, because that what you're doing is you're trying to lock in some of your gains and then extend your trade in some way, shape, or form so that you can potentially make even more money on that trade. So rolling is really about taking some profits on the table and trying to get more exposure in the directional view, because clearly the market has kind of confirmed your initial view was correct. And what you're trying to say is that I think it's going to continue to run. And that's really when you want to roll a contract.
Thank you, Tony. And I think a lot of these are really starting to line up nicely here because Jake has a question and he's asking about, covering the topic of repair option strategies. Can you talk to us a little bit about that?
Well, I couldn't have set up these series of
I
questions
know.
better. But so, to be realistic, there are probably, out of 100 trades, maybe two or three that are worth potentially repairing. The vast majority of repair trades, number one, you're taking on more risk to try to repair the trade, and I generally don't like doing that, because what you're doing is you're exposing yourself to more money, more risk, right? So you've already lost the money that you set out to risk. Now you're saying I'm going to risk even more than that on the same losing trade. And people who traders who choose to do that are the ones that potentially end up in a much bigger hole than they originally intended with a first trade. So that's why we generally don't find repair strategies suitable for most scenarios. But like I said, there are a few scenarios where repair strategies might make sense. There is one particular strategy called just what we call a repair strategy, is to actually repair a losing stock trade. You can basically try to repair a losing stock trade without taking any additional risk by selling what we call, twice the number of calls to an at-the-money call option that you purchase. And what that allows you to do is to try to get yourself back to break even a little faster without necessarily taking on a lot of risk. But there's very few scenarios where that trade can actually be structured. You can't be down very much. If your stock is down 50%, you can't put on a repair trade. It's usually for stocks that are down maybe 5, 7%, you might be able to put on a repair trade. And then, like I said, the other scenarios, if you're trading multi-leg, 3, 4 leg contracts, sometimes with butterflies and condors, you can effectively try to collect a little bit more income without taking on more risk to try to get yourself closer to break even or back to break even. But those are the only scenarios where it might make sense. And like I said, out of 100 trades, you might find that scenario to be true maybe 2 to 3 times out of that.
That's helpful. Thank you, Tony, for that explanation. I've got a bigger question from Doug, and I think it's one that everyone would love to hear your thoughts on, and it's around, can options hedge against expected potentially bear markets? So 2000, he's referencing 2008 and 2020. I don't know if 2020 was so expected, if we could see the math coming on that. But I guess the bigger question is, how do you hedge against bear markets?
Um, Doug, this is a bit of a loaded question. So in terms of the option hedge itself, that part is arguably the easier part to structure, right? You can do a simple put option, you can put on a put spread. In terms of hedging a bear market, I think the tough part here is, the expected part, right? How do you expect a bear market? I think by the time you're expecting a bear market, it's probably a little bit too late, meaning buying insurance is probably going to be quite expensive here. But theoretically, if you had a crystal ball, or if you had a pretty high confidence that you felt the markets were going to pull back here, first of all, what I always advocate before you think about using a derivative to hedge your portfolio, before you think about, using futures or anything like that to hedge your portfolio, the first thing you should think about is just moving into cash, right? That's the easiest hedge. That's the simplest hedge that doesn't cost you any money, and then simply try to buy back the asset once you feel that the market has done correcting, right? That's always the best, simplest, cheapest strategy to do if you truly are trying to hedge yourself against a bear market. And it's a true hedge, right? Because if, it doesn't matter how far the market falls. If you're sitting in cash, you're not going to lose any value. But if for whatever reason you need to remain invested in the market for tax reasons, for dividend purposes, for whatever other reason, you need to remain invested in those assets, and you have to look at using something like a derivative, like a put option, to hedge your portfolio, then you generally want to keep things really simple as well. You want to buy a relatively short dated option that's slightly out of the money, that's going to buy you kind of that convexity, that leverage that you want on the downside, because markets tend to move much faster to the downside than they move to the upside, right? We always say markets take the elevator down and the escalator back up. So, whenever you're buying put options, you can do a shorter dated option, and that's going to actually give you a little bit more leverage, a little bit more protection if it does crash here to the downside. So hopefully that gives you some thoughts, but like I said, it's a bit of a loaded question because no one really expects the bear markets necessarily.
Yeah, hindsight for sure. Doug, thank you for that question. And I want to go to Francisco for our last question, and it's a more general question around best practices when trading options, and potentially even just, is there any just good practices around what to avoid or what to pay attention to?
Yeah, I mean, we covered some of this stuff, but I definitely think that what I see a lot of traders do is they don't have a great plan for exiting their trades before they get into their strategy, and specifically to the downside, meaning when trades don't go in your favor. And a lot of times we have the best intentions, and a lot of times we have even a well laid out plan. When you're actually losing money on a trade, a lot of times we tend to freeze and we say, I know I should be taking this loss, but it's more of a human nature thing where taking on that loss means that I have to accept that I'm wrong. I have to accept that I'm losing money. And a lot of people avoid doing that. We kind of sweep it under the rug. And what happens in the long run if we keep doing that in terms of our behavior, we end up losing more money than we intend to. So that's one of the things that I really encourage traders to spend some time kind of doing a bit of introspection and kind of think about like what you're feeling when a trade is going against you, and start to learn how to get comfortable with that, how to get comfortable with the concept of that you're going to be wrong on quite a few of your trades. Get used to cutting your losses when you say you're going to cut your losses, because that's going to make significant improvements to the overall performance of your portfolio if you're trading options. And that's probably the best advice that I have for traders when you're starting out, is to learn more about yourself and how you're feeling when you're losing money, and also when you're making money as well. But more importantly, when you're losing money, and making sure that you're capable of actually sticking to the plan that you've set out for yourself.
Thank you, Tony, and thank you, our audience, for asking such engaging questions. This has been fun. Tony, thanks so much for taking the lightning round here.
Now, that was a lot of fun. That was some fantastic questions that were asked there. Thank you so much for setting those in, and thank you so much, Roberta, for walking us through those.
I agree. So before we wrap up our conversation for the day, Tony, can you just give us a quick idea of what's on the agenda for next week on In the Money?
Yeah, we have an action-packed week next week. It's one of the busiest weeks for earnings season, so we'll certainly be covering more earnings plays next week. You have a very packed economic calendar. You have Q4 GDP coming out next week. You have the January FOMC interest rate meeting, which we do expect interest rates to be held constant. But I think what's really important is understanding the language and maybe what changes Chairman Powell will state with regards to expectations for rate cuts for 2025. That's going to have a huge impact on overall investor sentiment. And then we also have the core PCE inflation data coming out. That's the preferred inflation gauge for the Fed. That's going to all drive market sentiment next week. So a lot that we'll be covering during the In the Money session next week.
Excellent. We are definitely looking forward to that. And this does bring us to a close. Again, I want to thank all of our viewers and all of those who asked questions today. And thank you for tuning in. Tony, huge thank you to you for bringing us your thoughts, trade ideas, and answering all those great questions.
Thank you so much, Roberta. Thank you so much, everyone, for viewing this today.
Absolutely. And if you're interested in further details specific to Tony's trade ideas that were shared today, please join us for our midday market briefing, which will be held tomorrow. And you can do that by visiting fidelity.com/in the money follow-up. And if you're also looking for further insights or you missed the live show, be sure to sign up for the Active Investor Weekly newsletter to receive highlights of the trades discussed. You can do that at fidelity.com/active Investor Weekly. Next week, we'll see you back here for another episode of In the Money. Take care.